So let's look at United Airlines. And the first thing we need for the model is the market cap, which is 11.36 billion. And then the stock price, 39.10. So now we know the shares outstanding because it's the market cap divided by the stock price, which is 291 million shares outstanding. So the way we're going to calculate the intrinsic stock price is we're going to estimate the future free cash flows of the company, then discount that dollar amount back to today's values, and that gives us the value of the entire company. And then we're going to take that number and divide it by the shares outstanding, and that gives us the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's selling at a premium or a discount. So let's get the actual free cash flows. We'll go to the financial section in Yahoo, go to cash flows, and then pull the free cash flows. So it's positive except for 1 year it's negative. So this is a good indicator of the health of a company, how much cash is left over after operating the business. So you can see in 2017 they lost $500 million, so they had to take on new debt in order to keep the business going. In the other years they were able to add cash flow to the business and increase value to their investors. Let's look at the income statement because we want to get the net income, which is the profit or loss for a given time frame. And every year they had a net profit. Let's look at the revenue. And that's just the sales for a given time period. We're looking at each year. So you can see in 2017 that a $2 billion profit, but they leaked $500 million of cash. That's why net income on the income statement is not the best indicator of the financial health of a company. And you don't forecast net income, you forecast free cash flow, because net income can be a little tricky because they have a lot of non-cash items. So in one time period, it could look like the company's doing well, but in actuality, they lost a lot of cash. So always look at free cash flow. Now we need to understand the capital structure of United Airlines so we know what the discount rate is. So the interest they pay on the debt is $646 million. Now let's see how much debt they have. We'll go to the balance sheet. Go to liabilities section. And the current debt is $1.4 billion. And that's debt due within 12 months. Let's see the non-current debt, the long-term debt. That's $13.1 billion. So they pay 4.44% interest on the debt. Debt interest payments are tax deductible, so let's get their effective tax rate. Income before tax. So we'll go to 2019 at 3.9 billion of income before tax, 900 million of taxes. So the effective tax rate is 23%. So the cost of debt is 3.4%. And over half their capital structure is debt, which isn't such a great number to see. They only have 1.4 billion of debt due within 12 months, so that's not too bad, but it's still pretty leveraged. But it is an airline, so that's just the nature of the beast. Let's figure out the cost of equity. So let's get the beta. That's the volatility of the stock, 1.12. So the cost of equity is 11%, cost of debt is 3.4%. Equity is a lot more expensive than debt because equity is riskier. In the event of a default, debt holders are paid first, then equity holders, if there's any left over. So the weighted average cost of capital is 60.7%. That's a blend of the equity and the debt. And that's what we're going to discount the future cash flows by. So we estimated cash flows out 4 years. Let me just, before I get to that, I usually just input the numbers straight from the financials and let my model do the calculations. But for this particular instance, I didn't calculate the revenue off of the previous years, because if I did that, you could see the revenue is over $40 billion. And 2020, it's probably not going to be even close to $40 billion with coronavirus. So what I did, I went to Yahoo Finance, and if you go to the analysis section, there's estimates from analysts, like analysts at big banks. They provide estimates on how the company's going to be doing in the next couple of years. So they give revenue estimates, and I took the average revenue for 2020 and average revenue for 2021, and I input that into the model. Because if I didn't do that, the calculated stock price would have been way high, and it just wouldn't have been realistic. So I took the revenue for those 2 years and just put it into the model. So it gave a much more conservative picture. So the free cash flows, it's a couple billion for 3 years, but you see it drops to 721 million. This is definitely a conservative approach, and it is an airline, one of the bigger ones, so they're going to get hurt pretty bad during this pandemic. So these are the cash flows we predict in 4 years. Then we have the terminal value, which is all years after year 4. Then we present value those numbers back to today's dollars, and we get a value of UAL of $15 billion, and when we divide it by 291 million shares, we get an intrinsic stock price about $51. So it is trading at a 23% discount. It's trading at $39. So you can see the stock was way over 50. It was like close to probably 100 at one point. And so this is common with companies that really struggle during difficult times, is the stock price gets driven down because a lot of people are selling the stock and they're just not as comfortable with the future of the company. So it's up to you. Do you feel the future of the company is worth more than $39? If you do, you should buy the stock. And if you don't, then you shouldn't, or you should sell the stock. So that's kind of difficult to predict. But I also want to go through some of the ratios. And I need some more info for the balance sheet. I need current assets, current liabilities, and the equity. So let's go back to the balance sheet and just pull those numbers. So the current assets is assets that can be liquidated into cash within 12 months. That's what current assets are. So cash is obviously cash already. You don't have to do anything to it. But receivables is what customers owe to the United Airlines, and receivables is generally due within 12 months or much less. And inventory, it could take a few months to liquidate it, but you probably wouldn't get nearly as much as $985 million what it's worth. But anyways, current assets $7.2 billion, and current liabilities is liabilities that UAL owes within 12 months. So they have to pay these dollar amounts back within 12 months. Current debt on the bondholders, and accounts payable is what they owe their vendors and suppliers. And then there's other liabilities. Deferred revenue is probably the best one. Now we need equity, which is the value of the company. And that's $11.5 billion. Let me just make sure I got. Let me get the 2019 numbers and the current liabilities. Okay, so equity is total assets minus total liabilities. Some people call equity net assets. So now we have the ratios populated. So PE is one of the most popular ratios. That's price over earnings per share. And I like to see a PE under 15. And this has a 3.8 PE, which is really, really good. Obviously, there's more to it than just PE, but that's a really good sign. So that either two things occurred for it to get such a great PE. Either the stock price became lower because the lower the stock price goes, the lower the PE will go, or the denominator, at the bottom of the fraction, the denominator, the earnings per share increased, so net income increased. Or to add more confusion to the equation, shares outstanding might have decreased if they bought back shares. Because when companies repurchase shares, that's a really common thing, especially the last decade. It really drives up the price earnings for a company because it lowers the shares. It's hard to really visualize this unless you're really comfortable with these ratios. But so this is definitely a good sign so far. Price to sales is a good ratio to look at for companies that are more in the growth mode and might have a really, really high PE. But in their case, they have a really great price to sales. So under 2.2 is what I look for. But the thing with price to sales, it doesn't take into account profits. So you might have a great price to sales ratio, but if you're not converting into profits, it doesn't really mean too much. And price to book, generally a 1 is considered amazing. So their assets minus their liabilities are, if they liquidated their business, they can pay off all the equity holders. So price to book of 1 is pretty great, but it doesn't necessarily mean the company's great. They might have a lot of problems on the balance sheet, such as high intangible assets. Let's look at their balance sheet. Non-current assets. So if you have goodwill and intangible assets, and they have $7 billion of it, that could really inflate your price to book ratio and make it look much better than it is. Goodwill is just a premium companies pay when they acquire another business. So it's not an actual asset. The current ratio under 1 is problematic, and they're under 1. They're 0.55. So this is a big issue, because below 1 means the company does not have enough assets to cover their short-term liabilities. Let's see if we could identify it. 8.2 billion of current assets and 14 billion of current liabilities. So all this means is that they just need to take on more debt. They need to take on 6 billion of debt just to cover their current liabilities over the next 12 months. They just don't have enough cash. They only have half of it is, a little more than half is cash, and then some investments. And they have a little bit of inventory receivables. But obviously the cash and the short-term investments are the most beneficial. So not a good sign. That's a pretty bad sign, actually. ROE, we want to see above 20% because the higher the ROE, the more efficient the company's generating income from the equity that it got from the sale of the business, the sale of stock. So just because it has a high ROE, I wouldn't feel too comfortable investing in a company with the current ratio below 1. But let me know in the comments what you think about these ratios. It's concerning, but it is an airline and it's during a pandemic, so I guess what can you expect? I want to try to do the same analysis with the other airlines so I can compare all the ratios together. That would help a lot, because that's what you should really do, is compare the ratios of similar businesses and compare the ratios of the same business over several periods, like several quarters, several years. That gives you a really great picture of the company and the investment. Okay, thanks everybody for watching.